India possesses massive entrepreneurial potential within its scheduled caste, tribe, and female populations. However, these demographics find themselves systematically locked out of formal capital markets. This exclusion is driven by the mechanics of credit rationing. Commercial banks distribute capital based on established credit histories and significant hard collateral. First-generation founders from marginalized communities typically lack both generational wealth and decades of financial records. When they seek capital, they hit a structural wall. Rather than a malfunction, strict collateral requirements represent a highly effective risk mitigation feature of commercial banking. Because the system operates exactly as designed, natural market forces will never bridge this funding gap. Reaching these excluded demographics requires a highly engineered, top-down policy intervention. In April 2016, the government of India launched the Stand Up India scheme to solve this exact institutional friction. By leveraging the massive pre-existing commercial bank branch network, the scheme operates at a structural scale, distinct from traditional microfinance or standard welfare handouts. The policy executes a primary mandate. Every scheduled commercial bank branch is legally required to facilitate at least one loan to an SC or ST borrower and at least one to a woman entrepreneur. This single statutory requirement forces a risk-averse commercial banking sector to actively seek out first-time founders who previously would not pass standard loan filters. The Stand Up India scheme succeeds by transforming a broad social developmental goal into a structured, unavoidable commercial banking mandate. Directing capital past normal banking filters introduces the risk of capital leakage. To prevent established players from hijacking these funds, the scheme applies strict demographic rules. Looking directly at the eligibility criteria, the first layer is precise. The borrower must be from the SC or ST category or be a woman, and must be strictly over 18 years of age. For non-individual enterprises, such as private limited companies or partnership firms, the parameters tighten further. A minimum of 51% of the shareholding and controlling stake must be held by an SC, ST, or female entrepreneur. This majority stake rule operates as a defensive mechanism. It prevents established corporate entities from setting up shell companies and using marginalized individuals as figureheads to access the capital. Setting these strict demographic boundaries ensures that this specialized financial inclusion mandate cannot be exploited as a source of cheap debt by existing corporations. The most critical technical constraint of the entire scheme is that the loan is restricted exclusively to greenfield projects. In this context, greenfield means it must be the beneficiary's absolute first venture into entrepreneurship, specifically within the manufacturing, services, trading, or agri-allied sectors. These funds cannot be injected into brownfield projects. The capital cannot be used to expand existing operations, buy out a competitor, or restructure old corporate debt. The greenfield restriction forces the market to create completely new physical assets and generate net new employment from the ground up, instead of financing existing players. The Stand Up India scheme provides capital at a significant scale, issuing bank loans ranging from a minimum of 10 lakh rupees up to a maximum of 1 crore. This capital is delivered as a composite loan to avoid the complexity of fragmented credit lines. It covers 2 needs. The term loan finances fixed assets like heavy machinery, while working capital secures daily operational cash flow to keep the lights on. The capital stack is heavily weighted to favor the borrower. The bank loan covers up to 85% of the total project cost, meaning the founder only needs to bring a maximum of 15% as margin money. The repayment parameters are designed to prevent early default. Interest rates are capped at MCLR plus 3%. The repayment window extends up to 7 years, and it includes a crucial 18-month moratorium. This combination of high coverage, low initial margin, and an 18-month grace period mathematically engineers a runway. It gives first-time founders the time they need to stabilize operations before immediate debt obligations threaten their survival. This raises an obvious banker's dilemma. Why would a commercial bank approve a 1 crore rupee loan to a founder who has no track record and insufficient physical collateral? The government solves this equation through the Credit Guarantee Fund Scheme for Stand Up India, or CGFSIL. This fund acts as a sovereign umbrella. It absorbs the default risk on behalf of the lender, functionally replacing the need for the borrower to provide traditional physical collateral. However, financial risk is only half the threat. Issuing large sums of capital to inexperienced founders is operationally dangerous without formal business training. To address this, the scheme mandates hand-holding support, which connects borrowers to specialized agencies like SIDBI and NABARD. These agencies provide rigorous pre-loan assistance, including financial literacy training and project report preparation, followed by post-loan mentoring to guide the business through its fragile early stages. Stand Up India functions as a fully integrated de-risking ecosystem that secures the lender's balance sheet while simultaneously stabilizing the borrower's venture. We can validate the efficacy of this policy intervention by looking at the macroeconomic data to see if this engineered bypass successfully mobilized capital. Since its inception, the scheme has sanctioned over 40,700 crore rupees across more than 180,000 accounts. Breaking down that distribution reveals a significant focus on female empowerment, with over 1.44 lakh of those loans sanctioned directly to women. The data proves that strictly enforced commercial mandates can rapidly and successfully penetrate historically excluded demographics at a massive scale. The Stand Up India scheme successfully forced the alignment of social inclusion with rigid commercial banking frameworks. By explicitly filtering for greenfield projects, the scheme ensures that every rupee deployed results in net new economic activity rather than corporate shuffling. Stand Up India provides a scalable, engineered blueprint for transforming marginalized demographics from passive job seekers into resilient, first-generation job creators.